Good day, everyone. Bert Salazar. I'm the host for the Bert Salazar Retirement Show, which is the only one on Facebook Live. So once again, I'm excited to be here with you today. This is not going to be a long show by any means, but it's always an important one because, there's a big difference between being long and being brilliant. So I always try to be brilliant to all of you. For those of you that are watching, please, I would appreciate if you can hit like and you can share, and if you can make some comments, obviously that would be awesome as well. Um, the name of the show today, and this is episode 11, by the way. If you had to do it all over again, and that's the name of the episode. As you get older, you start thinking about the things that you could have done differently in your life. What was it Frank Sinatra used to say, that regrets were there a few, but too few to mention, and so forth. But all of us, if we had an opportunity to do it all over again, which no one ever does, but if we had an opportunity to do it all over again, what would we do different? What would you do different? So I decided to take a few minutes of your time today and kind of share with you, what are some of the things that I would think you would do different, or you should do different. And in my case, definitely some things that I would do different, because at the end of the day, we can all improve our lives and we can do better. And if we can learn from our mistakes in the past, then we can move forward and try to make them better at some point in time in the future. So I broke the retirement show today into three parts. What would be the personal changes that I would make and that perhaps you should consider as well? What would be the business changes? And then obviously, last but not least, the financial changes. So those are very, very important. Now, for each and every one of us, trying to do it all over again depends on your own personal circumstance. Some of you may not want to do anything over again, but I would argue that most of us would. And one of the things that I can tell you is that if I had to think through it all over again, there's an old saying that nobody cares how much you know until they know how much you care. So, one of the things that I would want to continue to embark upon and to try to better myself at is letting people know how much I care for them and how much I care about their situations. Although as a business professional, I do a lot of that on an ongoing basis, because I like to show my clients and my online community how much I care about their well-being from a financial and from a personal standpoint. But I would argue that if you had to do it all over again, always remember that nobody cares how much you know until they know how much you care. So that's important to note. The second thing is I would probably, and this would apply to me, I would probably have a little bit more, or a lot more patience. I have a military background as a U.S. Marine. We like things to be in an orderly fashion. And then obviously I spent years in law enforcement. So when you have a military and a law enforcement background, your world is kind of black and white. And it took me a long time to figure out that there are many shades of gray that you need to be able to deal with, because, very few things in life are actually either black or white. So how do you manage the shades of gray would be something that, all of us could probably think about and probably do better on. And that's something that would be a win-win for you and your family, I would imagine, for many years to come. One of the things that I definitely regret in my life, both my parents passed away already. My mom passed away in 1996 and she had cancer. And then my dad passed away of a stroke 8 months later in 1997. The one thing that I hit myself over the head every single day of my life now is that I wish I would have talked to my parents a lot more. Now, we had a very good relationship. We had a strong relationship. I was an only son, so they cared for me very, very much, and I cared for them indeed as well. But I wish I would have been able to have more quality time with them. I wish I would have been able to sit down with my mom and sit down with my dad and learn more about their personal lives and their struggles and their trials and tribulations. My mom suffered two exiles because, You know, she had to leave Spain when she was 14 years old during the Spanish Civil War, never to see her family again. And that was one area of her life that she never wanted to talk about, but I should have made it a point of digging in and trying to learn more about my family, because now I don't know much about them. Now I've been going to Spain lately, and will continue to do so for years to come to learn more about my side of the family. But it's a struggle. It's hard to do, especially from the Civil War to today. And then obviously she had another exile when we left Cuba in the late 1960s to come to the United States. So, you know, I wish I would have had the opportunity to talk to them a little bit more about their struggles and like I said, trials and tribulations. That would have been very, very nice. Now, I would say I would try to stay healthier, although I'm fairly healthy, and obviously I get a checkup every single year. I'm in decent shape. I work out 3-4 days a week. I lift weights. So I ride my bike and I walk and I jog and so forth. But I would pay more attention to what I eat. I would try to control the kind of food that I would want to put in my mouth, because obviously the better you do when you're young, the better life you're going to be once you get older and once you retire. So those are things that from a personal standpoint, those would be the personal changes that I would make. And I don't know how much of this applies actually to you, but I would imagine to most of you that, you know, have had a parent that has passed away, you know, you're always questioning yourself as to what you could have done better. And then obviously when you look at your health and other parts of your life and your family, you would have done some of that as well. Now, what business changes I would do? I would say one of the main ones would be that I would take a look at every business decision, and I would start with the end in mind. You know, many a times, and I would imagine this happens to you as it's happened to me, you make business decisions without really thinking through all of the pluses and the minuses and the consequences and the opportunities. So about 15 years ago, I decided to start making those decisions with the end in mind, meaning, you know, what do I want to accomplish in the future, in the next 3 years, in the next 5 years? And how do I make those decisions today to make certain that I would have a very good chance to be successful in 3 to 5 years based on the goals and objectives that I have set out to be. So starting with the end in mind is something that I would recommend to all of you from a business perspective. Because at the end of the day, if you don't know where you're going, any road is going to take you there. So, you know, if you get up in the morning and you get in your car, you have no idea where you're going. You know, whether you make a left or right or a U-turn, you're going in the right direction because you have no idea where you're going. So understanding your business plan and what you want to do with it, I think is going to help you dramatically as you move forward into the future, especially when you start to make, you know, financial decisions, not through a microscope, but most important through a telescope, because the view is going to change for you and your family dramatically as well. You know, another point that I see here is that the older I get, the smarter my parents become. And I think that would apply to each and every one of you. I remember when I was growing up in New England, I grew up in Boston, you know, my parents didn't know anything because I knew it all. You know, I would argue with my parents and I would say, Mom and Dad, you know, you guys don't know anything. I mean, come on, I know what I'm doing. Well, the older I get, you know, the smarter they become. And now more than ever, they're a lot smarter today than they were 10, 15, 20, 30 years ago. So I would imagine this is something that for all of you would apply. Pay attention to the world around you, especially the business world, because it's always changing. I had an old law professor in college that used to say, you know, Bert, the problem with the world is that everybody knows the answers, but nobody knows their questions. So you have to be able to ask the right questions so you can start focusing on the right answers, because it's your life and your business life, even your personal life, is a bouncing ball, and you got to keep the eye on the ball, because otherwise it's going to go all over the place. For those of you like myself that were executives here for many, many years, and you're still an executive today, always take a look at your business surrounding. See who's moving up the ladder, who's not, and what changes you may want to see or you're starting to see that that are going to happen at some point in time, and that it could either have a positive or a negative impact. And how do you adjust, how do you adapt, and how do you improvise like we used to do in the Marine Corps when I was there, because everything that we did in the Marine Corps was about adjusting, improvising, and then figuring out what to do from there. So that's something very important, and that's something that I like to keep in mind for the rest of my life. I would have, in my business life, I would have dedicated a lot of my financial life to tax planning and retirement distribution planning, because I've been in the industry 30 years, but it was only about 15 years ago that I really started to, to concentrate on retirement distribution and tax planning. Because what happens is, when you're someone new in the business that I'm in, which is financial services, you get bombarded with all kinds of information, and then obviously you got this funnel that comes in this way, and then it narrows as more and more time comes, because you get to concentrate on the things that you really like about financial services and which ones you want to concentrate on. If it was up to me, and I would recommend this to each and every one of you, that it's either in a business career or if you own a business, instead of having your traditional funnel, try to concentrate on an inverted funnel, which means you're going to start inverted. So that means you're going to start very concentrated and very dedicated. And then obviously your success is going to widen, because if you concentrate and you become an expert in one area, then obviously you're going to be successful. It's not about doing 5,000 things at a time. It's about doing one thing 5,000 times, and then that's how in fact you would be successful. Whether you own a restaurant or you own a plumbing company, or whether you're in my business, whatever business you're in, I think those are things that are very important to consider, because the more dedicated and the more concentrated you are in your business, the better off you're going to be. So now I've talked a little bit about your personal changes. I've talked somewhat about business changes. Obviously, they apply to me, but I would imagine that they would apply to many of you. And then I want to spend a little bit more time on financial changes. If I had to do it all over again, what would be some of the things that I would change from a financial standpoint? And I've done fairly well financially, but by the same token, you can always do better. I would think that the first one is, I would save 20 cents out of every dollar that I have ever earned. So that means that I would save 20% out of every dollar. I remember when I was working in high school, I would have started saving 20% or 20 cents out of every dollar at that point in time. I would be so much better off today than I am, because most Americans are not savers, they're spenders. So, and I deal with a lot of Americans that are either in retirement or very close to retirement. Everyone tells me the same thing: Bert, I wish I would have saved a lot more money in my lifetime. And if you start saving as early as you possibly can, then it's not going to put such a tremendous pressure on you, because you would have time on your side of the ledger in which to save a lot of money. And then obviously it would give that money the opportunity for growth from a business standpoint. So I would definitely save a lot more money. Now, as an employee, I would invest in a 401k exclusively and only up to the match, because anything else that you put into a 401k, you really have no control. Taxes are going to be governing everything that you're going to do in life. You have no idea how many, because as part of my business, I do tax planning. So we have an accounting firm. So I do accounting, for individuals and small business owners every year. And then every single year when I do the 1040s and the tax returns for clients of mine that I retired, the one thing that they complain often is about the fact that their taxes are not going up, that their taxes are actually going up. Their taxes are not going down, they're actually going up, because of the fact that most of their retirement accounts are taxable accounts. And when you start pulling money out of your 401ks, your IRAs, your 403Bs, your drop money, your deferred compensation programs, and so forth. Now you're going to be paying taxes at a point in time in your life where your deductions, exemptions, and your credits are already gone. So, and that's without considering the fact that taxes are going to have to double in the very near future, or our country's going to go bankrupt. By the way, I checked these numbers again yesterday. Our national debt is now at $26 trillion and counting. Our national deficit, that means the difference between the money that the US government brings in versus the money they spend every year, is now at $3.3 trillion. Last year was $1 trillion. Because of the pandemic that we're going through right now, it's up to $3 trillion, and there's no end in sight for that. And then last number is the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt. Those liabilities today amount to $148 trillion and counting. So if you don't think that taxes are going to go up in the future, then I would suggest that as soon as you finish watching my retirement show today, that you call 911 and you go to the hospital because you need to be checked out, because there's something wrong with your brain, because taxes are going to have to double, or our country's going to go bankrupt. And in the meantime, you know, if all of your accounts and all of your pensions and all of your income is being taxed, now you're going to suffer a 30, 40, even a 50% loss of income, because at the end of the day, it's about the net income in your pocket and not the gross that you generate from one year to the next. So I would definitely not put any more money into my 401k other than up to the match, and that would be it. Now, I would create, one of the things that I would definitely do, and I've done it, but not to the level that if I had to do it all over again, I would start creating immediate cash flow by investing in real estate. Now, I'm not a real estate agent, so I'm only going to talk to you from a financial standpoint. But when you put money away in qualified plans like your 401ks and your IRAs and so forth, you're basically delaying expenditures to the future. So if you're 40 years of age, you know you're not going to touch that money until you're at least 59 and a half. Well, what happens in the meantime? Why can't you set up a type of investment program where you can start generating cash flow immediately thereafter? Now, I have a lot of clients, and I've had some properties myself, and I do have some myself, but I have a number of clients that have been investing in real estate for a number of years. Now, some of them, you know, buy real estate property, they fix it up, they flip it, and then they sell it. Others keep it as income properties. And the clients that do the very best, because I do a lot of their taxes and their tax returns and their tax planning, the clients that have a tendency to do the very best are buying real estate properties as income producing properties. So they may be investing in small apartment buildings. Now, if you want to do that and you're still young enough, then start saving some of that money into the taxable bucket. Now, if you don't want to pay taxes, buy municipal bonds, so that way the money can grow tax-free. But if you start putting that money into your 401ks, then you're not going to be able to have access to that money unless you pay penalties in order to save enough to buy a piece of property. But you can use leverage in real estate and really maximize the rate of return for you and your family. So some of these clients are buying small apartment buildings, anywhere between 12 to 20 units apartment buildings. They either manage it themselves, or they set up a management company and they take one of the tenants. That may be someone who's handy, somebody who may be trustworthy, and they give the rent on the apartment for free. And then this tenant is responsible for managing the day-to-day operation of the apartment building. And then obviously he or she would collect the rents or fix anything that may be wrong. And they have access to, you know, the plumbers and the carpenters and the electricians, depending on what the needs are. So you have the ability to do that. I have a number of clients that also invest in duplexes and triplexes. And those are excellent investment alternatives because you're generating cash flow. When I started generating cash flow from real estate about 30 years ago, I started to generate close to $300 a month. Now that may not, I think it was like $250 a month. Now that may not sound big to you, but that's an additional $3,000 a year that was coming in. And because of the fact that I used the leverage of the deductions and exemptions by investing in real estate, that was pretty much tax-free money. Now today, my income is much higher than those $250 from a real estate perspective. But I'm just giving you the idea that you need to start right away, because cash flow is king for you and your family. And cash flow gives you the ability to invest in opportunities, because you may have an opportunity to sell one small apartment building, so one duplex, do a 1031 and pick up another one that you can get a much higher rate of return on that one than the one that you currently own. So, and if, by the way, any of you may want to do any tax calculations on the real estate property, if you think you're thinking about buying one, feel free to reach out to me. I'm not going to charge you anything, and I can do that calculation for you. So that would be important for all of you to know as well. Obviously, income producing properties are things that would be very, very important. By the same token, I would try to make that income, and I would do it in such a way. I have a number of clients of mine that what they do is, I have one client, just to give you an idea, and I did it for the first 5 years, and then it was working so well that I just stopped doing it. But not really. What happened was I used to work for a public company. I got a major promotion out of South Florida and was moved over to Southern California to run a very large organization over there. So I really didn't have anyone that I trusted here in South Florida to manage the property. So little by little, I started to get rid of them. But I have a client of mine that over the last 15 years, what he has done is he has bought a piece of property every year. Now, some years it has been a duplex, other years have been a triplex, other years have been, I think he owns maybe perhaps 3 or 4 small apartment buildings. The smallest one that he has, I think, has 8 units in the apartment building, but he's had one of the 4, I think the last one that he purchased has 32 units. But what he does is he's been buying these properties every year. And then every 10 years or so, he goes ahead and refinances the property and does a property cash out. So that means that he's able to take large amounts of money out of those properties. And because it is a loan, he's not going to pay any federal income tax. And then he uses that money to supplement his lifestyle. And now he's getting closer to retirement. So he's going to continue. Now he wants to get to 20 properties. So he's got another 3 to 5 years to go, because sometimes he's purchased 2 properties in a year. And he always looks for the right opportunities, because opportunities provide you with flexibility to maximize your return. The other thing is that when he refinances the properties, guess what? Your tenants are the ones paying the mortgage, because you're going to charge rents accordingly. And he also always leaves a little bit of a buffer in the property in case there's a market downtrend in the value of the real estate, that he doesn't get caught upside down. But he's been doing this for years, and he's been doing this extremely well. So if you buy 15 properties, and then in year 15, just to give you an example, you refinance property number 1, obviously you're going to have a lot of equity there. And then the following year, you do property 2, property 3, and so forth. And when you get to the 15th property, or the 15th year refinancing, then the property that you refinanced 15 years ago now has a lot of, hopefully, a lot of equity in it, because of the 15-year amortization structure and the 30-year amortization, which is what he does with all the property. So it's a great way to do it, and it's a great way to generate cash flow immediately and not have to wait until you're 59 and a half or 60 or 62 or 65 or 70, whenever it is. So you're going to decide to pull the trigger on your retirement life. Now, I would obviously also save my money in 7702 plans. And I do have a lot of that. 7702 plans are cash value life insurance plans, where the money that you put in is after tax. The money grows tax deferred, and then you can pull the money out tax free. But you have so much more flexibility in a 7702 plan that you would have in any type of qualified plans like a 401k, IRA, 403b, and et cetera. Because in a 7702 plan, you don't have to worry about the IRS code, other than you don't want to overfund it to the point that it becomes taxable. But you can pretty much dictate how much you want to overfund your 7702 plan and for how many years. You can pull the money out prior to age 59 and a half, pay no taxes, pay no penalties. You're not obligated to start pulling the money out at age 72 under the new law. You can let the money continue to grow tax-free if you want to. You can actually put riders in there for long-term care benefits, so it'll protect you from the fatal four, the risk of dying too soon, living too long, living with a disability, and or living with eroding factors like taxes, inflation, loss opportunity costs, and so forth. I have a number of clients, and in my case, I also have a lot of money in those 7702 plans, but I have a lot of clients, a number of clients, I have 7702 plans that have been overfunded to the max, and they do so every year, and they use it as a business source of refinancing and income. So I have a client that owns a meat manufacturing company, and every once in a while he's got to buy a new piece of equipment. That could be 100, 150, 200,000. Instead of having to the bank or go to the bank and try to finance it, now if the arbitrage of the interest rate is lower, then he'll use the banking institution. But many times he just says, Bert, send me a check for 200,000, and then I want to pay it back in 5 years and do me an amortization schedule in which I can pay this loan back to myself in 5 years, and then obviously be able to use the money all over again. And then when I retire, I'm going to start using it as a supplemental retirement plan, or you can use it as a supplemental retirement plan. So 7702 plans give you a lot of leverage. It allows you to actually evade principal and interest at the same time, because a death benefit portion of the 7702 plan would be paid on a guaranteed basis, depending on the carrier and their guarantees. And they're also free from federal income taxes, which is a win-win for your family and for your beneficiary. So that's important to understand. I do have a fairly sizable annuity portfolio to create guaranteed paychecks in retirement. Now, I haven't pulled the trigger on those because I'm not retiring now or anytime soon. So I'm going to wait a few more years for that. And then that money will continue to grow tax deferred. But if I had to do it all over again, I would have started putting more money into annuities, and I would have done it earlier than when I started. I believe the first time I put some money into a non-qualified annuity was when I was like 45, 46 years of age. I wish I would have started when I was 30 years of age, because obviously, I would be in a different position today from that perspective. So I would encourage each and every one of you to also consider that guaranteed paychecks in retirement are irreplaceable. There's nothing better for you and your family. And if you have a guaranteed paycheck coming in that can take care of your fixed and your variable expenses, then obviously the rest of the money that you have and the rest of the investments that you have, you're going to have a lot more flexibility, because you don't have to worry about the fact that, if I make a financial mistake, how am I going to be able to pay my bills? Because your guaranteed paychecks via annuity straddles are going to be able to handle that for you and your family for the rest of your life. So that's a win-win for all of you. And then the last one is if you own a business and you buy automobiles and you buy cars, I'm okay if you want to buy a car every 2 to 3 years, or if you want to lease it if you own a business, because obviously you can deduct a lot of those expenses depending on how you factor your automobile expenses on your tax return. But if I had to do it all over again, instead of purchasing, although I've been doing that now for the last 20 years or so, but I bought a bunch of cars earlier than that, and I would buy a car every 2 years, or I would lease a car every 2 to 3 years. If I had to do it all over again, this is something I recommend to all of you. I would purchase an automobile and not lease one, and I would purchase it for 10 years at a time. So you're going to finance it for 3, 4, or 5 years, and then you're going to keep it with you for another 5 years. Now, the money that you were paying in financing fees, let's say you finance a car for 60 months, whatever that monthly payment was, once you pay it off, since you're going to keep the car for another 5 years, continue to put that money into a side account. You can put into municipal bond funds so you don't have to worry about the taxation of it. Because now when you get to year 10, if you want to sell your automobile or you want to turn it in and you want to exchange it for a new one, now you're going to have a lot of money that you're going to be able to give in us a down payment, and we'll continue to do that. The reason why I'm using 10 years is that there's an enormous loss opportunity cost when you buy a car. Because if you pay, let's say $40,000 for an automobile today, it's not only the $40,000 that you put into the automobile, it's the fact that that $40,000 is not earning any additional interest on your behalf. So it's not only the $40,000, but also the interest that your money could have earned on your behalf that is no longer doing so. So therefore, that's where the loss opportunity cost. And I have a calculation and a calculator that will figure that out for you. And the numbers are in the hundreds of thousands if you buy a car every 10 years versus buying a car every 5 years or 3 years, because most Americans are changing their automobiles every 3 years. Now, obviously, you got to take care of your cars because otherwise they're going to break down and so forth. But 10 years is a good time for you to, trade in your automobile, buy a new one, because at least you can recapture some of that opportunity cost that you would have lost otherwise if you would have accelerated the trade-in of your vehicles from 10 years to, let's say, 5 or 3 years. So that would be important. The last point, and this goes back to the 7702 plans, I would want to have all my 7702 plans paid up by age 60. So from age 60 forward, I can use all that money. Even if I don't need to, I could just leave it there, but at least you would have the leverage and the opportunity to use it as a supplemental retirement plan. And also at some point in time, because of the risk of living with a disability, which is one of the highest risks that you're going to be facing in life, because the probability of death is 100%, but the probability of a long-term care illness is actually 70%. So 7 out of 10 Americans are going to have some kind of a long-term care illness before they die, and therefore that has become very costly and very needy for Americans to be able to take care of. So, I'm hoping that you're enjoying these retirement workshops and the retirement show that I'm doing for you every single Wednesday. I also put out a lot of videos, a lot of educational videos. I also have a podcast channel. I just finished yesterday doing 115th episode. So feel free to go on your podcast app in your cell phone, and you can download my podcast, which is called Your Tax-Free Life. And then you're able to listen to my podcast while you're in the car going to and from work, or whenever you listen to podcasts. If you do want to get a hold of me for anything or any discussions that you may want to have regarding financial matters, please feel free to call me. Area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at BertSalazar.com, B-E-R-T, SALAZAR.com. So it would be Bert at BertSalazar.com. And always remember that my goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So, once again, at least South Florida, the beaches are open, so I'm excited about that. I went to the beach over the weekend and had a really good time. I hope that all of you are getting back into your lives, and that you and your family are doing well. So obviously, I'll make sure that I'll talk to you again next week. I want to wish you the very best. Stay healthy, and I'll talk to you soon. Take care.